How is it going, guys? I hope you guys are having a nice weekend. I have just finished my little presentation here for you guys because I know there's been a little bit of confusion in regards to premium and what it means to actually sell it, what it means to buy it, what it is actually at its very base, and why sometimes taking like a 1 to 2 risk is okay because you have a higher win rate. So let's get started and dive right in. And if you guys have any questions, feel free to message me in Discord or on any other way that you know that I'm available. So I've done this nice little Photoshop presentation, so I hope this works. So options pricing first. Let's just see how options are priced. At any point in time, there's two kind of parts that a options price can be comprised of. One is intrinsic value, the other one is extrinsic value. So looking at intrinsic value first, it only appears if a option is in the money. So if you have like a $10 strike, your option, $10 strike option, and the stock is at $10.50. The option's intrinsic value is 50 cents. As for extrinsic value, it's always around, but it varies depending on several factors, and depending on how much time there is left until expiration, it is higher, but it decreases slowly as time passes. But why there is a extrinsic value in it is because you need to pay for the rights to buy or sell stock at a later point in time. Otherwise, this will give you like an unfair advantage. And this is what we call the premium. The premium of an option is usually referred to when we talk about the extrinsic value. So now let's look at intrinsic value just a little bit more in detail. So as I've said before, it equals the amount the amount or the distance an option is in the money. So if a stock, as I just said, is a $10 strike call and the stock is at $10.50, your intrinsic value is 50 cents. It's the distance between your strike and your current stock price, or we call it the underlying. So if an option is out of the money, logically it means that intrinsic value is zero. So that when the option is out of the money, all it's comprised of, like all its price, is completely extrinsic value, or as we say, premium. So let's look into that a little bit further. So extrinsic value, it is comprised out of several factors, and I'm not going to go into this too much in this lesson. This is going to be something for when you look deeper into the Greeks. But as I said, it is the premium you pay for the right to buy or sell a stock later in time. So, and it also means that the more time there is left until expiration, the higher the premium, because that's what we call the theta, and the higher the volatility of the underlying, the higher the premium, which is volatility, vega, implied volatility, has different names. So only at expiration, the premium or the extrinsic value is ever at zero. There's always like some premium or extrinsic value in an option until it has expired. It doesn't mean that the option itself is going to be worth zero if it is in the money. It's going to have some intrinsic value left, but all the premium will be out of the option once it has expired. So now let's look what happens if you buy an option. So if you buy an option and the stock does not move, the premium decreases, or as we say, it decays. As I've mentioned just earlier, because slowly, like there's less time until the option expires, and so there's less time for the stock doing anything crazy that might influence the option's price. So that decreased amount of uncertainty decreases the premium you have to pay. If an option is out of money at expiration is worth zero, we've just covered that. So now, but what is interesting, if you paid for 50 cents for an option, it needs to be at least 50 cents in the money, so you have like enough intrinsic value to cover what you've paid for it. Otherwise, it loses money, as intrinsic value, as I just said, is not enough to pay for the premium you paid. So that means that in any trade, that there are three things that can happen. The stock goes up, stock goes down, or stock stays the same. So when you buy an option, you only make money in one out of these three scenarios. And even then, you only make money if the stock moves enough to cover the premium that you paid. So if you buy an option for 50 cents and the stock moves in your direction but only ends up, as I show here, at 30 cents in the money, the option is now only worth 30 cents. That's the intrinsic value that's left. So you paid 50 cents, you can now sell it, or you're receiving 30 cents, or you get the stock at 30 cents less at expiration. That means that you have a 20-cent loss. So from the get-go, your chances of winning are, on paper, 33%. However, your potential profit is theoretically infinite. So the stock can go to 1 million, and your option is going to be at 1 million as well. And your max loss is capped at whatever you paid for the option. So if you pay like 50 cents for an option, it can't go to less than zero. So 50 cents, the max you can lose is times 100 is $50. We've went over that it's all times 100 before. So I hope this makes sense, that if you buy an option for 50 cents, it's actually you pay $50 for it. So that's like your max loss whenever you buy an option or you buy premium in that sense. So now let's look at the other side. When you sell options, that's my favorite side. So when you sell an option, you are shorting that option. So it means when you profit when the option's price decreases. When you're selling an option, you collect the credit, and during the trade, this almost acts like a cushion, so that the trade could even go a little bit further against you before you start losing money. And I'm going to explain to you right now how exactly that works. So if you sell an option for 50 cents and the option ends up 30 cents in the money, so the stock has went completely against you because you wanted it to go. Say you sell a put. That means it loses value when the stock goes up, and the stock goes down and ends up 30 cents in the money. It actually went against you, but you still make a profit since the option is only worth 30 cents and you shorted it for 50 cents. So you make a 20-cent profit on that option. So selling options, as we looked at the three scenarios that we saw before, this is actually a 66% chance of winning from the get-go. However, the price of the option can't go lower than zero. So your maximum profit is capped at the amount of credit you receive. Also, your maximum loss is theoretically infinite. So what you had before, you had a high potential profit but a low possibility or low probability of it working out. And here it's vice versa. You have a high probability of the trade working, high probability of winning, but you have a low potential profit, which is if you sell the option for 50 cents, the most you can make is those 50 cents. It can't go lower than zero. So that is basically it. So let's conclude this real quick. Selling options, it increases your probability of profit, as I just said. And I think to build an account, you want to make consistent gains without losing too much all the time. And you have a theoretical 66% chance to win if you sell premium versus if you buy premium. So your win percent can even be increased even more by managing at 50% of profit. But I'm going to go into this another time. That's just the basics. I hope it makes sense to you guys that there's no way around this. You can't have a high win percentage and a high potential profit. You always have to trade one for the other. And lastly, I wanted to give like a quick bit of credit to where it's due. All of this stuff I've learned from the amazing guys at Tasty Trade, and I hope you guys are going to go and acknowledge their amazing content that they are providing. And I don't want to be appearing as this is anything novel that AI came up with on my own. I'm just trying to teach it in my own words to you guys, so you guys understand how I am making my profits, and we can all coexist. We don't have to, like all pretend we're the only guru in the freaking world who knows these secrets. This is public knowledge, and every options trader who's done this long enough, they know that this is a credible way of making money. So with that, guys, thanks. If you have any questions about this, let me know. This was way shorter than I thought it would be. That is nice. So you guys have a nice, quick bit of information. I hope I didn't go too fast. If you want me to go over it slower, I will gladly explain it to you in chat, or I'll do it like a live stream and you guys can ask live questions. But yeah, this is it for now. Please like the goddamn video, and please comment if you have any questions as well. That would be cool. Give us like some love for the YouTube algorithm so more people can see it. And have a nice rest of the weekend, and I'll see you guys on Monday. Cheers.